All right, let's get started. It's 11 o'clock. This is your 20-minute Annuity Tuesdays. My name is Trent Zimmermann, and I'm the Director of Annuities here at BGA Insurance. BGA Insurance is a wholesaler of annuities working with financial advisors, independently licensed life insurance agents, and we work with not only annuities but life insurance, long-term care, and disability. Myself, I have a background with a bachelor's in economics, a master's in finance. I'm a chartered financial consultant and chartered life underwriter. And this is your 20-minute Annuity Tuesday. We're talking about turning qualified funds into long-term care funds, but we're going to do things a little bit differently this time. We're going to see if we can get a little bit more class participation. So this one's going to probably be a gimme. But what's the top financial concern? So what are most clients' number one financial concern in retirement? Single choice answer. Answers are going to be not having enough growth in their assets under management, being unable to loss harvest effectively, outliving savings, or having a long-term care event. All right. Wait for a few more answers here. All right, 90% of you are saying outliving savings, 10% of you are saying having a long-term care event, and none of you fell for my cheesy answers. Uh, and we're looking at, oh, come on. 82% of clients rate long-term care as the number one financial concern. Those of you who answered outliving money, 64% of people fear running out of money more than death itself. But many of those 64 rate long-term care higher than that because what's the fastest way to deplete an estate is having a long-term care event. 42% of people believe having a long-term care event would completely deplete their savings. So there's going to be overlap of people saying outliving money and having a long-term care event. But whether you are uh, poor or wealthy, everybody fears a long-term care event. We have some other stuff in here about expecting to discuss philanthropy and 42% of people being underinsured in life insurance. But these are just stats to show that we have in our toolbox solutions for people's problems. Um, there's a massive need. Oh, shoot. I was going to have you launch this one here, and I went ahead too quickly. So if you saw the answer, how many adults turning 65 today will require some form of long-term care event? Uh, Most of you should know the answer because I just showed you that answer. What's the average age of a long-term care event? How long is the average long-term care event, and what's the average cost? If you can scroll down on these answers, and you'll get all four questions. I'm sorry, I'm still getting used to doing these questionnaires. We're looking at how many adults turning 65 will require some form of long-term care, 10%, 40%, 70%, 100%. What's the average age of a long-term care event? 65, 73, 82, or 96? How long is the average long-term care event? 6 months, 2 years, 4 years, 20 years? And what's the average cost of a long-term care event? 25 cents, $50,000, $85,000, or 130? Looks like we're getting all the answers in. I'm going to share the results. All of you got it right. That it is 70%. What's the average age of a long-term care event? Some of you guessing early, some of you guessing the RMD age of 73, but it's actually 82 is the average age. And how long is the average long-term care event? Some of you saying 2 years, but it's actually 4 years. Uh, and what's the average cost? Some of you answering 85,000, but the real answer is going to be 130,000. So let's go back to the slide. This is the one I accidentally showed you. And so with 82% of people saying it's their number one concern, and 70% of people actually having an event, and it costing close to $130,000 a year, and only going up faster than inflation. If you aren't having these conversations with your client about getting them long-term care coverage, somebody else is. So before we talk about qualified funds into long-term care, uh, we're talking about the types of long-term care insurance. We have traditional LTC, life insurance with an LTC rider, hybrid LTC, and long-term care annuities. So here's a layout of the four different products that you have available to you. Now, if we're talking long-term, traditional long-term care, this is going to work a lot like health insurance that you pay in every year. There's no cash value. If you die, the money is gone. It's going to be the highest level of coverage available to you, but you have no premium certainty. When you need that coverage the most, when you're 82, you are going to be paying astronomical amounts for it. There is no death benefit, so that money is going nowhere if you're in the 30% that doesn't need long-term care coverage, or if you're in the 70% who do need long-term care coverage and it's shorter than 4 years, it's a quick in and out, you're not getting any of that money back there either. And it is the hardest to qualify for. Now, we have life with long-term care. This is good for people who need life insurance, need a permanent policy, and then are able to say, I wouldn't mind being able to tap into some of that death benefit and cash value if I have a long-term care event. So because you are getting underwritten for permanent life insurance, it's still going to be more difficult to get this kind of coverage. Um, but it's going to be easier than traditional long-term care. You do have a death benefit there because it is based off of life insurance. And you can do ongoing premiums, you can do lump sum, you can do 7-pay, you can structure it however you want. This is going to benefit people who are buying this young as well, not for people who are planning going into retirement. So we have the last two, hybrid LTC and long-term care annuities that are designed for people approaching retirement, designed for lump sums or hybrid LTC in short pays. And these are going to be similar products that are going to reposition idle cash. That's why they call it asset-based long-term care. Now, when we look at these, they're going to have high premium certainty and the coverage leverage. I know I gave the annuity 2 stars and the hybrid 4. It's not exactly true, and you'll see why. There's some nuance to this. So a long-term care annuity is going to be a lump sum. You're going to be receiving 2 to 3 times the leverage, and you're going to be receiving that long-term care income for usually about 6 years. And this is tax-free income that you're going to be receiving if you can't perform 2 out of the 6 activities of daily living. Hybrid long-term care is going to be pretty similar, except you have a larger death benefit pool that you're going to be tapping into, whereas the death benefit here on the annuity is just going to be that cash value. Now, because you're buying a life insurance product here with a hybrid LTC, it's going to be a little bit harder to get underwritten for, but you're going to have the ability to pay in multiple payments and pay over time, either for lifetime, 10-pay, 7-pay, or the lump sum. So there's a little bit more flexibility here, but let's look at a comparison of the two, annuity versus hybrid, because they're going to be functioning fairly similarly. You get an annuity, and that total LTC benefit is going to roll up over time with a guaranteed growth, just like it would in an income annuity. So that year one benefit is going to be less than your benefit at age 82. And you're going to see that age 82 benefit is about 150% of what the day one benefit is. Whereas on the hybrid side, it's the exact same day one and at age 82. And this is based off of lump sum. If we were to 10-pay this hybrid, it would look different. If we were to build in much larger um, inflation hedges, it would look different. Now, so we're just comparing apples to apples here. So when you're thinking about annuity versus hybrid, and we're not comparing flexibility, which one's better for your client? It depends. It depends at what age they're buying this, how much time they're gonna have to let this roll up. If they're more concerned about having the death benefit at the end because they think they're less likely to have this event happen, or if they think that it's going to happen sooner rather than later. And then there's some questions about how these pay out, but that we'll cover later. So when you're talking to clients and they're approaching retirement and they're worried about these LTC events, you're going to have these two products in your back pocket. And when's the best time to plant a tree? 20 years ago. When's the second best time to plant a tree? Today. Start having these conversations with your clients at age 50, age 55, at 60, so that you can start preparing these and have that roll up ready and let their assets under management recover from this payment earlier on. But the rub is this next quiz. What's the largest pool of funds for retirees? Is it their pension plans? Is it qualified funds, non-qualified brokerage accounts, checking accounts, savings accounts? And then the next question is, can asset-based long-term care accept qualified funds? I think the second one kind of gives you the answer for the first. All right, we're going to end the poll here. I'm going to share the results. So you all know the answer. Qualified funds is the largest pool of funds for retirees. Now, when we're asking, can asset-based long-term care accept qualified funds? The straight answer is no. And I get this question every single week that can I put qualified funds into a long-term care plan? And I say no, but there are strategies around that. And oftentimes I don't get a follow-up to that, and I'm calling them, seeing what they want to do. And they're often worried that it's going to be too complicated. So neither hybrid LTCs or annuities can directly accept qualified funds. What's the solution? It's much easier than you think. Get a 10-year period, certain single premium annuity, pays into a 10-pay hybrid long-term care product. It's easy as that. If you want to pay in monthly, get in a few extra tranches, protect yourself if you're doing an index product, even better for you. You can do this as a 7-pay, you can do it as a 5-pay, but it's as easy as that. And you want to know the better part of this is One America will build it all for you. One America will say, we'll accept that money, we'll put it into annuity for you, and we'll directly fund our hybrid long-term care product. Otherwise, if you're using Nationwide, if you're using John Hancock, if you're using Global Atlantic, all these you are going to have to build it yourself, which actually might benefit the client if they say, I want to do this, but I don't want to pay the taxes out of pocket. So now you're going to have to do some tax assessment, work with a tax professional, and say, how much of this this single premium annuity income do we have to allocate towards paying the taxes, and then what's going to be left over to put into this this product? Or you can say, I'm going to put it all in, I'll pay the taxes out of pocket, uh, and have it all go into your hybrid long-term care product. So the benefit of this is you can now, when you're talking about annuities, you're pretty much only going to get reimbursement as your benefit method. Whereas when we're talking about hybrid, you get now the other benefit of getting indemnity as well. So you now have a way to convert qualified funds into non-qualified funds to put them into this vehicle and do it in a way so that those funds are protected outside of all the other retirement income that you're planning. And you can do it in a company that will handle it all for you, or you can build it yourself. And now you get access to different types of benefit methods. So now when we're talking reimbursement or indemnity, the difference are going to be reimbursement works like health insurance, indemnity pays you a check. At the end of the day, that's what you need to remember. Whatever you spend, you're going to need to keep the receipts for reimbursements, whereas indemnity, they'll just give you your max benefit amount and that's it. Reimbursement means if you're paying less than the amount of benefit that you could be receiving, this benefit period could last longer than the 6 years. So when we're looking at indemnity and how they pay, I can send all this to you and the pros and cons. Reimbursement tends to be a little bit cheaper than indemnity, and reimbursement, some people will say it's harder. There are companies out there like John Hancock that have concierge programs that will help you. And if you are a person who has gone through a long-term care event with a family member, you want the help. No support group, no therapy is going to be able to prepare you and give you the resources you need to be able to take the keys away from your parents, know which type of resources are best rated, and giving the best type of care for the elderly in these facilities, or if they're just low grade and under lawsuits, and you wouldn't know because they're putting a forward face onto it. The issue with that is reimbursement. You're going to have that 90-day waiting period, and they're going to require oftentimes full-time care for those 90 days. And a lot of people are going to want home-based care and might not need full-time care in the early stages of a long-term care event. So we're going into this, and we have now this availability to get indemnity and be able to get benefits sooner. But you might be able to say, look, I want to layer some of these. I want to get indemnity for the early stages, and then I want to get a second policy that's reimbursement. So I'll split that amount and put them into two hybrid products that I can benefit from in different ways. That when I need the full-time care and I have less of my faculties about me, my family will be getting help from a concierge system. And in the early stages where I do have my faculties, I know I'm not doing as well. I want home care and it's going to be part-time. I can get indemnity and just get the check and be able to handle this on my own. So we talked a little bit which one's right for you. And so let's just talk about positioning this. And I know I just launched this again before I asked the question, but how much money do you think is coming out of surrender periods in 3-year MYGAs this year? Is it 10 million, 20 billion, 40 billion, or 60 billion? And how much money in annuities is sitting outside of surrender right now? That's 60 billion, 100 billion, 400 billion, or $1 trillion? All right, this is the most spread we've had. And the poll, share the results. Take a good look before I stop sharing and send it over. We're looking at $60 billion in MYGAs this year coming out of 3 years from when the rate increased in 2023. They're coming up for renewal this year, $60 billion and 400 billion in annuities sitting out of surrender entirely. So when we talked about earlier that this is a massive desire for your clients, 82% saying it's their number one fear. The other 18 still listed it in their fear, but 82 saying it's their number one fear. 70% of individuals turning 65 are going to have a long-term care event. And we had a massive uptick in annuity sales 3 years ago when the rates increased. And now we're having a deluge of billions in annuities leaving surrender periods. These are the conversations your clients want to have. How can they reposition their assets that they already have into long-term care? Are they willing to pay that? And then the question just becomes, are you willing to pay, if it's qualified funds, the taxes out of pocket, or do you want them to come out of the qualified funds? And you can start saying to people, we can get you a restrictive policy that will pay a good amount, last at minimum 6 years, roll up over time, or we can get you one that will pay you all the money in a check, or we can build a custom plan for you and get a dual policy strategy. And we always talk about income here. I mean, that's most of what annuities do. And we've talked about the income doublers that they have for LTC events that isn't technically long-term care coverage that you can get for people who can't qualify for long-term care. Again, it's not true long-term care coverage, but it has the same triggers. And you can start to build income plans that include long-term care safeguards in there and add on true long-term care on top of it. And pairing those two together can protect somebody's assets from being completely blown out by a long-term care event. So the answer is simple. I know we had this long webinar just for me to say buy a SPIA, period certain, pay it into a whole life strategy of a hybrid LTC. But as I've said, this is a weekly conversation I have. And when I say there's a strategy around it, all you need to do is ask, do you want the taxes coming out of your qualified funds or do you want to pay out of pocket? And then it disappears. It's easier than you think. It doesn't have to be complicated. So, if you want any of this information, if you want our fact finder as well, and if you want to send that fact finder back filled out so we can run retirement simulations for you, call me, email me. My information is here. And now I'm launching the last quiz. This doesn't count towards your final grade. It's just asking what you want the topic for next week to be. We're talking about AUM protection plans. How can you protect the amount of assets you have under management by getting annuities to make sure that people aren't pulling money out in down years? Rolling over annuities with this deluge of annuities coming into out of surrender periods. What do? What are strategies to roll these over? We talked about one being long-term care, but there's plenty more. The RISM deep dive, that's a strategy we talked about last week about buying income, having a buffered asset, having time segmentation, and then having your growth assets under management. And then asset-based long-term care deep dive, just going into asset-based long-term care. We'll do more of a deep dive instead of just a simple strategy. So right now we are tied with 2. So I'm going to give you 30 more seconds to break this tie. If you haven't voted, your vote does matter. All right, we just had 2 more people vote and they tied it up again. All right, so here's what I'm going to do. I'm going to end the poll. I'm going to share results. Let's talk about rolling over annuities next week, and then we'll do an asset-based deep dive the following week so that we can have a break from long-term care and bounce back in. So with that, I'm opening up to questions. I know we're over 20 minutes, but if you want to hang around for questions, please do. Otherwise, get on out of here. It's been your 20 minutes. Thank you so much, and I'll see you next week. And remember, have those conversations today. I'm on that. Don't wait.